dual aspect concept. Okay, so here what we call as dual aspect, why we call as dual aspect concept is, for an example, if there is a transaction, okay, you're lending your notebook to your friend, you're just giving your notebook to your friend. See, here it is only one statement, that is one activity, okay, which means you're just giving your notebook to your friend. That is only one activity, but there are two people involved in it. One is you, and the other one is your friend, which means you become the giver here, which shows the giving aspect, and your friend becomes the receiver, which shows the receiving aspect. So, every transaction in the business will definitely have two aspects in one transaction. Okay, so here, as per this concept, both the aspect of the transaction are to be recorded. That is why we follow, according to our standards, we follow the double entry system, which is again called as dual aspect concept. So we follow the dual aspect concept, where there will be a debit with the corresponding credit. Also, there will be a credit with the corresponding debit also. Okay, so here there is an accounting equation followed for this aspect, which is capital and liabilities. Okay, when we add these two, your assets must be equal to the capital and liability. So this is the important equation for which we'll be doing certain sums in the next chapter. Okay, there's an example also given here. Arun starts a business with cash rupees 5 lakhs. On the one hand, the business gets cash of rupees 5 lakhs. On the other hand, a liability arises, that is, Arun is giving a sum of rupees 5 lakhs, so which means for business they are receiving cash. Then who is giving it? Arun is giving it. So there are two aspects involved in the transaction. Okay. The next one is periodicity concept. So here, what is called as periodicity is, which is nothing but where we follow the accounting cycle or the procedure for a certain period, that is for a particular period. Say normally it will be 1st April to 31st March of next year, what we call it as accounting period. Okay, so for every accounting statements, we'll have to prepare these statements once in a year, which means we have to enter all the transactions every day, but the financial statements are prepared on the last day of the accounting period, which means we always follow 1 year as the accounting period, which starts on 1st April and ends on 31st March of the next year. Okay, so that is what is given here. Periodicity means there should be particular period followed. Okay, that is what is called as periodicity. And next is matching concept. So this is most important. Again, matching concept means for whatever income we receive, that is revenue we receive, there must be equal expenses. Okay, for example, say parent is receiving an income of say rupees 50,000, and he spends rupees 30,000 in a particular month. Okay, for his revenue is 50,000, he has spent 30,000. Still, he has 20,000, which will be shown as his savings, but in business we call it profit. Okay, so there must be an equal revenue which is to be matched with your expenses incurred during that particular year. Okay, so why it is being specified that particular year is, there may be few expenses. For example, you should have, maybe you must have paid your installments, okay, EMI, in the month of August or in the year 2020. But since maybe you forgot, or you forgot to renew. Okay, so in that case, you actually outstand there is an outstanding expense of, say, certain amount of loan which you should have paid. Okay, whatever we call it as EMI. Okay, so if you are not paying that EMI on that particular year and you pay it the next year, but still the expenses are supposed to be incurred in that year, so you have to include that amount also in your current accounting statements and show it as outstanding expense. Okay, I'll repeat this matching concept. Matching concept means whenever you receive any revenue during an accounting period, then it must match your expenses. Okay, it is not compulsory that you have to spend all your incomes to the expenses, but when you're making some expense, which means it should have been done only from the income that you got in that particular year, not the previous year's income. Okay, so that is what is called as matching concept. The next one is realization concept. So realization means revaluation, or when the business is going to wind up. In that case, all the assets wind up means when you come to close. Okay, when the business is going to be closed permanently. In that case, all the assets whatever we have for the business are to be sold out or realized. Okay, so in that case, if there is any change in the value of the asset, so those realized value will alone be entered in the accounting statements. But again, historical cost concept only we follow, but only while realizing, while selling the assets, the actual cost is being taken. Next one is objective evidence concept. So as we always say, in any accounting statements, if there is one transaction, there should be a proof attached for that transaction. For example, if you are paying, say, property tax. Okay, if you have paid the property tax, you would have received certain bill. Okay, printed copy, so that should be attached with your statement. So each and every transaction we make in the business must have an objective evidence. There must be a proof of document attached with the accounts statements. Okay, so why we attach this is to, when we check whether the accountant has record all the transactions or all the transactions correctly, or is there any fraudulent activity involved. So all such things can be easily identified with these proof of documents.